if you are investing your money for dividends, I love investing my money for dividends, you have to understand that taxes also apply to that income. So if you go out and you own an investment portfolio that's paying you, let's just say $10,000 a year in dividend income, well, you can reinvest all $10,000 back into your stocks, so you buy more dividend paying stocks, but you still have to pay taxes on the $10,000 worth of dividend income, even though you might never see that money. Just like that, when it comes to real estate, one of the reasons why real estate investors love investing in real estate is because of taxes. The real estate tax code allows you as an investor to file what's called a depreciation deduction. It is a paper write-off on your taxes that says you deserve a tax break because your property is 1 year older, period. And this allows some investors to make money, to make a profit, to have cash in the bank, and then pay little to no money in taxes legally. That allows you to keep compounding and growing your money without having to pay some of this money in taxes. Because the more money you can invest, well, the more money that you can have growing for you. And this is where now you as an investor want to make sure you understand how taxes are playing a part in your investment portfolio, because if your money is being eaten away by taxes, well, then you might be the one paying the price. You have your own goal when it comes to investing. For me, my primary goal when I invest my money is generating cash flow. That's why the bulk of my investments are cash flow producing assets. But not all of my investments are for cash flow. I have some investments that are more on the speculative side, like I invest in some startups. They don't pay me with cash flow, but they're more fun for me, and I also understand the risk, but they're more on the speculative side that hopefully they will be able to grow in value and make me money, because maybe some of these startups will get acquired one day. That's the goal with startup investing. And so now when you go out and invest your money, before you just throw your money into the stock market, know how it is you want to get paid. Are you looking for growth? Are you looking for slow and steady growth? Are you looking for fast growth? Or are you looking for cash flow? And if so, how much cash flow? And if so, do you want growing cash flow? And if so, do you want steady cash flow? You have to start asking these questions because, again, risk plays a part with the return that you're going to get. And the type of goals you have are going to determine how you want to get paid. And when you understand this, that can completely change the way that you're going to do your investment analysis, because you want to make sure that you're investing in something that aligns with your goals. What's a good investment for me might not be a good investment for you. And what's a good investment for you might not be a good investment for me. Warren Buffett likes to say that the stock market is a device that transfers money from the impatient to the patient. And what that means is you go through these cycles in the economy, but we also go through boom and bust cycles in every single asset class. Stocks, real estate, cryptocurrencies, startups, it doesn't matter what you're talking about. Every asset class goes through these booms and busts. And what happens is when you are in a particular part of the cycle, everybody thinks that this is going to stay forever. When I first started investing in real estate, it was 2011. And I knew nothing about investing. I knew nothing about real estate. I did not have any real estate mentors. I didn't even know that you could invest in real estate. I didn't know anybody that was investing in real estate. I just started investing. But the sentiment at the time was that real estate prices are going to stay low forever. Nobody's going to ever want to own a home, and home prices are going to be depressed for the rest of forever. Well, clearly that didn't stay the case. As real estate prices started to go up, well, then you start to hear the opposite. You hear people talking about how real estate prices can only go up, how real estate prices can't go down, how real estate prices are going to always be high. You see the same thing with stocks. When you start to see a boom in any asset class, whether it's artificial intelligence or tech stocks, when things are going up, you hear about how this asset class is going to change the world. It's going to revolutionize things, and this is going to only go up from here. When it's going down, you hear about, oh my God, it was so overvalued. This bubble is over. This asset class is done for. No one's going to ever use this again. I mean, if you remember back to the 2000 dot-com bubble bursting, a lot of people thought that the internet, quote unquote, fad was done for. And because it was done for, people thought that nobody would ever use the internet again. Well, we all know today that's not the case. But this is where there's a lot of emotions when it comes to investing. And your job as an investor is not to get caught up in the emotions, but pay attention to the underlying asset class and invest with financials rather than emotions. The kind of ironic thing about investing is sometimes you could do everything right and still be wrong. And other times you could do everything wrong and still be right and make money. And this is where you have to understand that there's this element of risk when it comes to investing that's sometimes out of your control. Like you could go out and invest in what you think is a great company, a great investment, a great sector, and then a new president comes in and they create this new regulation that essentially makes the industry that you just invested your money into bust. It makes it void. And that could severely hurt the value of your investment and the chance of you to ever make any money. And this is where you have to understand that investing comes with risks, and there will be times that you lose money. Not there might be times that you lose money, but there will be times that you lose money. But the key is to keep coming back and understand that the goal is to make way more than you lose. Losing is a part of the process. Every successful investor in the history of time has lost money at some point. It's not just you. And you have to understand that the key now to making more money is to keep coming back and keep learning, because, well, losing is a part of the process. And again, if you want to keep enhancing your financial education, I have tons of videos on my channel, and you can also check out the ebook that we have at Briefs Media down in the description. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.